Good morning, everyone. Welcome to this Gravita Inheritance Tax webinar. I'm Tim Palmer. I lecture all around the UK. I've been lecturing for a long time now as well, actually. Can I just tell you something that I think was reasonably amusing last week? I'm doing a lecture in London last week, and this guy comes up to see me at the very end, and he said, "You've been lecturing a long time, haven't you?" I said, "Yes, I have, almost 40 years. And he said, "Yeah, my dad used to come to your lecture." And I thought this guy was the same age as me, and I'm thinking, my goodness me. So I have been lecturing for a long time, but anyway, enough about that. As well as my lecturing, I'm a tax consultant with Gravita, which I really enjoy doing my role. It's fun as well as quite demanding, and I'm proud to do it. So Gravita is a really busy and rapidly growing firm. This is my take on the whole thing. And if you go to our website, you can see everything that we're doing, our team, the events that we put on, which I think are really good and regular. So you want to always, make a habit of looking at Gravita's website to see our blogs as well and everything that we're doing, really. And I must admit, I'm just going to give my personal views this morning. The more I get involved with Gravita, the more I see that we've got some outstanding individuals on lots of different tax areas that we can really help clients and accountants with the consultancy work for. Today, I'm hosting the webinar. It's a day off for me. I'm not actually lecturing. I'm going to leave that to Michaela. But so I'm hosting the IHT webinar today that my colleague and tax partner, Michaela Lamb, will be presenting. Gravita puts on a lot of these webinars. Can I just quickly say a few words on these? And they become really popular. When I was in London last week, an accountant came up to me actually, and he was complimenting me on behalf of Gravita of the webinars we do. And I think there's over 400 people watching today. So it's a big thing for us, and we've had a lot of good feedback from it. And I'm going to say just a couple of quick things. I don't want to eat into Michaela's time. She'll go mad with me.
It's fine.
It's okay. So I'm just going to say a couple of very quick things, if I may. We've been putting on a few webinars recently. And the two that stand out for me was the investigations one by Dion, and then we did a capital allowances one. And can I just remind you that if you do have any problems with investigations, I know we've done the webinar now, but contact us. And Dion, who's excellent, will really help you. And we'll be able to help you in the investigations area. Now, today, we turn to inheritance tax. I'm going to very, very quickly give my views on that. Michaela might disagree with me here.
Probably not.
But I lecture on inheritance tax, and I do a lot in practice. And I'm going to give you my views just for 2 minutes, 3 minutes on inheritance tax, which I think, right? The first thing I think is that a lot of clients ignore it. They do. And they just think, oh, it'll go away. But it doesn't go away. It never goes away. In all the time that I've been lecturing, inheritance tax is the one tax I think that clients like to really try and forget about and don't do planning. You give them capital gains tax, stamp duty, corporate, they'll do all of that. But inheritance tax is the one that's really expensive and the one that they don't do enough planning about. I've got a confession to make. It's only recently that I've done my will, me and my wife, and I'll tell you something that was slightly amusing. We sat down one Sunday afternoon to do our wills, and Bhavna is a qualified tax consultant as well, tax advisor. And we sat down to do our wills. And the first thing that my wife said to me was, "Can we agree one thing?" And I said, "What's that?" Thinking that she was going to do intense IHT planning. And she said, "Can we agree that you're going to die first?" And I thought, well, that is absolutely charming, absolutely charming. So I wasn't particularly happy about that. But just to finish my initial thoughts on inheritance tax, can I be serious for a minute? I think it's very expensive. I think that the HMRC sometimes, particularly with business property relief, deny it when it shouldn't have been denied. I've had lots of cases on that where we've had to battle to get business property relief, which we knew the client was entitled to. And there's been cases on that recently, which Michaela will obviously talk about, particularly the Eva Mary Butler case, where this lady had a farm. She converted a barn into a wedding venue, was running a business from there. She tragically died. The estate claimed business property relief. This is a very recent case, Eva Mary Butler. They failed to get it, and it cost the estate 1.6 million of IHT. Now, people have said to me, could that have been avoided? I've got to be careful what I say here. Perhaps they could have done a couple of extra things. I don't know. But this just shows that HMRC are quite aggressive with, trying to deny business property relief. And my final thoughts before I pass over to Michaela, I also think that gift with reservation of benefit, the GROB rules, are much wider than people think, and they can trap you without you really realizing it. And the other thing also I feel is that when you ask for advice on IHT, and we can give you all the best advice in the world, but you've got to think of the other taxes as well. You might be thinking of one particular transaction and think, yeah, this is the IHT solution, but it then might crystallize a big capital gains tax liability. So I'm going to pass you over to Michaela now, but the one thing I would say perhaps is to really listen to what she's saying today, and then at the end of it, reach out to her. And if you've got an issue, tell her what you want to achieve. And ideally, you really have got to approach us before the client has carried out the transaction. I think that's the key thing. And then Michaela, and we'll be able to help you. Right, enough about me rabbiting on about IHT, but you can see I feel quite passionate about it. I'm going to pass you over to Michaela now.
Thank you very much, Tim. Welcome everyone this morning to our webinar, Gravita. Wonderful introduction as ever, Tim, so appreciate that. I am going to crack on and try and open some slides, so please bear with me while I try to share my screen. It will be that one, I hope. I'm a bit of a tech numpty, unfortunately. So are we up, Hilary? Are we up? Excellent. Right, fabulous. Okay, so welcome to our seminar on inheritance tax planning. Today we are looking at various bits and pieces. So we've got, I'll do the introduction in a moment, of course, but we'll look at what inheritance tax is. We'll look at what has stayed the same. We'll have a quick look at some planning opportunities that still work. And then we'll go through a whistle-stop tour of what has changed as a result of the most recent budget, and of course, what might change if we end up with a different government. So inheritance tax is one of those things that actually appears in the press quite a lot. And over the last year or so, there has been a huge amount of rumours about this being scrapped or being changed, all this sort of thing. Labour has gone as far as to say that they were going to reinstate it if the Conservative Party scrapped it. So everyone was expecting something to happen. We even, our own Tom Adcock even wrote a piece on this, an opinion piece about what would happen if it was abolished and what would replace it. However, when we got the budget, what actually happened was actually a bit of a damp squib. There were some changes to the agricultural property relief, which will affect people, but not vast amounts. There were some changes to the way grants and credit work. Again, not going to affect a huge amount of people. But the big ones, of course, were the changes to protected trusts and the inheritance tax of non-doms. And in both cases, we don't really have the final rules yet because a lot of it's down to consultation. We will look at those in a bit more detail later, though. So what is inheritance tax and who actually pays it? Inheritance tax, as you probably all know, is a tax levied on the value of somebody's estate when they pass away. We look at the value of everything they had at the point they die, but we also have to consider gifting that they've done in the previous 7 years. It's also paid by relevant property trusts. Now, today's presentation will not look into much detail in trust. This is something which I'm very interested in. So if there is an interest out there for future, more than happy to present on that if people are interested. So please just let us know. But inheritance tax is paid by trust. So will somebody actually end up paying inheritance tax when they pass away, or will their estate pay it? So 2023, a recent poll by YouGov said that 31 people believed that their estate would be liable for inheritance tax when they passed away. I don't know if they were just asking the wrong people or whether or not this is just a misconception, which is what I accept probably is. In reality, less than 4% of estates actually pay inheritance tax. And in 2021, that was the figure. What we don't want is your estates or your client's estates to be one of that 4% if we can avoid it. Looking at recent statistics, we have 27,000 estates were taxable or liable to inheritance tax in 2021, and that was an increase by 4,000 from 2019-20. Now, a lot of that was probably down to COVID because the death rate was quite high in that particular year, but even so, we'll look at other reasons as to why. In terms of how much tax was collected in 2021, so the same year, 5.76 billion was paid in inheritance tax. And that's £1 billion, £1 billion less than what has been paid in the last 12 months. So we're now nearly £7 billion in the last 12 months has been paid in inheritance tax. So when the budget was announced, not a great deal changed. But what we need to consider is the fact that nothing changed. What is the impact of that and why is it important? So the big things that haven't changed, the 40% tax rate, that was introduced in 1984 and hasn't changed since. The transferable nil rate band has been available since 2007, but it still only applies to married couples. The nil rate band of £325,000 has been fixed since April 2009. And then the residential nil rate band hasn't changed from the 1,700, sorry, I can't say numbers today, apologies guys, £175,000 that's been fixed since April 2020. So the fact that the inheritance tax rate has changed since 1994, is that a 1984, is that a problem? Well, you have to look at it in the context of other taxes and what else is being paid. In that time, for example, the CGT rate has fallen. In that time, income tax rates have generally fallen, but inheritance tax hasn't. Wonder whether that's an issue. So the cumulative inflation over the last 40 years has been around 324%, but the increase in how much inheritance tax has been collected has actually gone up by 755%. In 1984, the total tax collected was 90 billion, which is about 1% of the total tax that was being, inheritance tax was 1% of the total tax that was being paid. In 2024, the most recent figures I have are 2023, the total tax that's paid is 390.9 billion, and inheritance tax made up just under 2% of that. So in reality, it is now forming a much bigger source of income for HMRC. No changes to the transferable nil rate band since 2007, but if we compare what's going on with married couples since then, it's quite interesting. Yes, the divorce rate has fallen to 6.7 people per 1,000 from 11.1, but in terms of marriages, there were only 85,000 marriages that happened in 2004 compared to in 2007, 241,000. My question is therefore whether or not this is actually still relevant in terms of how it should be applied. I am one of those people happily living in sin, but I don't get this relief. Right, we'll see. I'm not going to get married just to get it, I must admit. So the nil rate ban hasn't changed since 2009, and it's still at 325,000. Now, during that time, the average house price has gone up by 75%. Average income has gone up a little bit less, but it's still a huge amount of inflation going on. In general, inflation over that entire 15-year period has been about 50%. So houses is more. So what we look at, though, is whether or not more or less estates are paying the tax. In 2009, only about 15,000 estates were dragged into the IHT net. We are now on 27,000, so it's almost doubled. Residential nil rate ban is another one that hasn't changed for a very long time. This was introduced in 2016 to counteract some of the issues with the increases in house prices. Although if we look at 2020, the average house price was 250,000. Since then, in those 4 years, it's actually gone up by about 14% on average. Interestingly as well, this is another one I have a bugbear with, is that it can only be claimed if the property is being left to a direct descendant, so a child or a grandchild, for example, stepchildren as well. Interestingly, if you don't have children, you don't get this allowance. The birth rate, though, in the last 4 years is falling fairly significantly. So people aren't having as many children. So how long will this still be relevant for? Anyway, let's look at the opportunities that are still available and things that you can think about, bearing in mind what hasn't changed yet. Most important thing is to make the most of your allowances, which I think Tim was kind of getting at earlier. There are lots of allowances to be had out there. You should use them, or at least consider using them when you're thinking about your planning. The big one is the interspousal exemption. £15.7 billion was saved by people using the spousal exemption last year alone. This is because you can leave your assets to a surviving spouse without paying any inheritance tax. There's then some planning that can be done around that. For example, if your will leaves everything to your surviving spouse, you can consider then the surviving spouse making lifetime gifts. Because there is a CGT rebasing at that point, it can be more economical to make gifts at that particular time. Now, there is a restriction on the interspousal exemption for non-domiciled spouses or non-domiciled couples where the recipient is not domiciled in the UK. But again, there is planning that can be done around that because there are elections that can be made, and people sometimes miss that. The other thing to consider is that when gifts are made into an immediate post-death interest trust, that will still count for the interspousal relief. Now, there's not a great lot of tax planning that goes around using interest in possession trust, but from a practical point of view, it's very useful when we have blended families, for example. This ensures that the surviving spouse is taken care of, but children from perhaps the first marriage are not disadvantaged later. We could also think about deathbed planning. One of the things we've seen people do is if, unfortunately, one of the spouses is known to be very unwell and unlikely to survive, if all of the assets are gifted into their name immediately before their decease or the departure, unfortunately, then there is a CGT uplift on death. If everything is then left to the surviving spouse, there's no IHT to pay, and you've benefited from the CGT uplift. This is quite useful where, for example, where there are investment properties, they can be left to the spouse that's unlikely to survive, rebased and then sold on afterwards without the CGT liability. So there's some planning opportunities around that. If that's something you are affected by, you might be interested this week, we can have a chat about that. The transferable nil rate ban is quite useful. You need to remember that it can be used now irrespective of when the first spouse died. So if there are couples that were widowed a long time, or an individual was widowed a long time ago, they will still qualify for this if they received the bulk of the estate on the death of the first person. They can receive up to 100% of this, and it's worked out on a percentage basis of what was used. The planning point here is where there were multiple widowships, as it were. So if somebody has been married previously and they are going and been widowed and they are going to inherit a transferable nil rate band, then you need to work out how the will should look when they remarry, because you can only qualify for up to 100% of an additional nil rate band. And therefore, in some cases, it's not worth leaving your estate to a surviving spouse if they have already been widowed and have already got the benefit of 2 nil rate bands. There are planning opportunities around here, especially where there are children involved, so that needs to be considered. The residential nil rate band can provide a saving of up to £70,000 per person where possible. Now, this one's a very difficult one to actually qualify for, because if the estate goes above £2 million and you need to include all of the assets in the estate, even those that won't be subject to inheritance tax, for example, because BPR applies. If the estate is worth more than £2 million, for every additional £2, a pound of the £175,000 allowance is lost. Only applies to direct descendant, I've already said. If you sell a property, though, and you've done that after the 8th of July 2015, and the individual doesn't necessarily buy another property, they may still qualify for this under the downsizing relief provisions. The other thing to remember is that, again, if the individual you're advising, or you are the individual, has been widowed, then there is a potential to transfer another £175,000 from the deceased spouse, irrespective of when they died, or actually whether or not they owned a property at the time. If they didn't and they died before 2015, you may be able to get hold of this. Again, it's based on an unused percentage and they won't have used it. Sometimes we have to look at whether or not an estate can be reduced below the 2 million. And in some cases where somebody is cash rich, for example, that can be done. They may be able to gift away assets to bring the estate down to 2 million. And if you do that on your deathbed, it's not like you need the money at that point, but you need to be wary of triggering capital gains tax, because if assets are given away, what we don't want is a capital gains tax, because there's no relief for that from the inheritance tax. Usually with the interaction of capital gains tax, it's not worth it to save the £70,000 IHT saving. Again, it needs to be looked at on a case-by-case basis, though. Gifts to charity are quite a nice one. If somebody is already charitably minded, it may be worth considering increasing how much they're giving away, for example. IHT-free gifts can be made to charity anyway, but if they are more than 10% of the chargeable estate, and that's a bit of a fiddly calculation that needs to be done, it doesn't necessarily mean the entire estate, the IHT rate on what is taxable may be reduced down to 36%. We have seen cases where just increasing the amount of charitable donations slightly actually leaves the other beneficiaries of the will better off. Even if it doesn't, it's a very economical way of getting money into charities' hands, because the only real loser on this is usually HMRC. Not necessarily a bad thing. So in 2021, we know that 9,680 estates left charitable legacies, and that totaled 1.8 billion. So this is quite a big thing that people do. The other big thing to remember is to understand your reliefs. Use them or lose them. £4.2 billion, for example, was saved by people using BPR and APR in 2022-23. So again, it's a large sum of money. So I'm going to spend a little bit of time looking at business property relief, because this is probably the biggest thing that most of our clients ask us about, and whether they're going to get it, how to use it, and how best to kind of work with it. So for those of you who are not aware, business property relief is a relief that is given on particular assets, so business assets, and they can pass either free of inheritance tax or a rate of 50% of the usual inheritance tax liability. So it has to be a qualifying business that's being passed on, or shares in a qualifying business, and there is an ownership condition. It needs to have been held for at least 2 years. There's also a benefit for assets that are being used by a business, but those will only be 50% rate. And there are some provisions for replacement. So, for example, if you haven't held an asset for 2 years and it would qualify, if it's replacing an asset that would have done, then the times are added together. So it's not quite as harsh as it sounds. The things that don't qualify are those businesses that are mainly dealing with stocks, securities, land and building, which are there for investment, not for profit. Any business that is subject to a binding agreement for sale, and any business that's already being wound up. Now, those will not qualify, and you will pay normal inheritance tax on those. The other thing to be aware of is whether a business qualifies as wholly or mainly investing, because something that is wholly or mainly investing will not qualify for BPR. Now, HMRC apply a 50% test. They look at, in the round, does the business look like it's mainly trading, although they don't define it as trading. They look at the capital that's been employed, the time that is being spent by the directors and employees. They'll look at the turnover split, and they'll look at the split of profits. Now, it's an interesting test to look at, because you may pass some of the tests and you may fail other bits and pieces, but you have to ultimately look in the round. Does this business look like it was not wholly or mainly investing at the point that the owner of the shares or the owner of the business passed away? There are additional complications when there are groups involved, because it may be that the shares were held in a holding company, and underneath that holding company, there may be a number of trading companies, but there may also be investment companies. Each thing needs to looked at in the round, and then the holding company needs to consider what it's got, and again on a 50% basis. There are planning opportunities to consider restructuring if you have a complex group in place where there may be non-trading activities within it, and it may be that isolating those will improve the BPR position overall. There's also the opportunity to consider whether or not, if you own an asset outside a business that is used in your trade, whether or not there is any benefit of transferring this into the company to improve the BPR rate from 50% to the 400%. We also need to consider the concept of the accepted asset, though. Even if a business or a company qualifies for 100% BPR, if it has accepted assets within that, the allowances on that particular amount can be reduced. Now, what I mean by an accepted asset is an asset that's not been used in the business for the previous 2 years and that is not required in future. Classic examples of this could be cash that have been accumulated by the directors and the shareholders that is not being used. It's just being held in a bank account. It could also be amounts, though, that have been invested, and if they are being actively invested, they could cause a problem for the overall business. It can also include things like the holiday home that's been popped into the company or into the family company. That would never qualify because it's not part of the business. I have seen arguments where rental properties within a business sometimes have been allowed, but it gets a very, very fine line, and there are very specific conditions that need to be considered. Now, the planning opportunities here are to review any of the potentially accepted assets and try to create a case for why the money or the asset is retained by the business for the business. So, for example, if there is a large amount of cash that is being held on the balance sheet by a business that would otherwise qualify, there needs to be minuting to discuss whether that's being held because you're looking for new opportunities to invest in the business itself, or whether or not, for example, you're planning to buy a new premises. Those sort of things will make that money relevant. Without making the money relevant, though, you could find that those would be excluded from the relief at a later date. As Tim was saying, though, getting BPR is really, really hard, especially when you're thinking about property companies. So a property development company is much more likely to get it, but most other property companies don't. HMRC have been very, very specific and stated that landlords with commercial properties will never get BPR, irrespective of the hours they're putting in, facilities putting. We've seen this for services apartments, for example, where the deceased was doing a lot of work, was managing it, doing all the sorts of things that you would expect them to get as a business, but the BPR was denied. So check out the Bruce Firth versus HMRC case on that. As Tim mentioned before, we had a barn conversion that was let for weddings. Even though they were actively managing this as a wedding business and doing all the bits and pieces they ought to do with that, it was deemed that this was still an investment, and this was still investment activity because it was basically the building was being let out, and the BPR was denied. So this was the Butler case. There are exceptions to this, and the old exception used to be furnished holiday lets. The famous case on this is Graham versus HMRC, where the lady involved was putting in a huge amount of work and running this furnished holiday let. So she was providing not only the welcome packs and all the bits and pieces you would get, she was providing entertainment. They were putting on all sorts of facilities for their clients. And that was deemed to be a business, but that was unusual. For FHLs, it doesn't usually get it. The other thing we need to consider is that the rules furnished holiday lets are changing. We know they're changing. That was announced in the budget recently. What we don't know is whether or not that will have an impact on IHT and whether or not BPR is available anymore. I suspect it might, because they are being treated as non-businesses now. They're being treated as investments. If you do qualify for BPR, then the trick is to make the most of it. One of the things we see people do, because it's good planning, is to leave everything to the surviving spouse. In the case of BPR assets, you might actually want to consider leaving these, though, to somebody else, because the spouse is already going to get into spousal relief. Don't waste the BPR. You don't know whether or not your spouse or your surviving spouse is going to continue running that business after you've died, and whether then, when it's passed on to, for example, the children, BPR will still qualify. If the BPR assets are left to the next generation now, claim the BPR, and then if they decide not to carry on the business, then fair enough. At least that relief has been crystallised. The other thing to consider is lifetime gifting into trust. I said I wouldn't talk about trust, but I am going to make a concession here. There is a way of dealing with businesses, for example, that qualify for BPR now, which perhaps you might think about selling in future. So i.e. you would sell during your lifetime. If it qualifies for BPR now, there is an argument for putting some of the shares into trust now to crystallise that BPR. It's a good way of getting money into trust without paying the 20% entry charge, which is usually paid. Ultimately, the trust could end up holding cash because the business has been sold. And depending on the way the BADR works, they may not end up paying any more tax than it would have done had it been outside the trust in the first place at the point of sold. Now, there's also some very neat tricks about this, where you may be able to use BPRable assets to set up multiple trusts and qualify for multiple nil rate bands. This is fairly complex. It's very complex planning. And if it is something that you would like to consider, we can certainly have a chat about it. But there are some huge inheritance tax benefits of doing this kind of planning. I've included some bits and pieces on agricultural property relief because it depends on where in the country you are as to how relevant this is. But a huge amount of money is saved each year on people claiming APR. It applies to agricultural property, which includes farmland and woodland, but it only covers the agricultural value of the property. So that's a trap that many people fall into. What you have to consider is whether or not the excess value, so there may be more value in the property, so in a piece of land, because you could get planning permission on it. It may be deemed to have more value, for example. You need to consider whether or not you'd be able to get BPR on the balance, and that will be a case-by-case thing. If the estate includes farm or woodland that's been owned for 2 years and is owner-occupied, you'll qualify. If it is owned but not owner-occupied, i.e. somebody else is running the farm for you, then there is a 7-year ownership qualification that needs to be considered. Farmhouses are controversial. Lots and lots of lectures that I've been to in the years talk about these. They may qualify, they may not. It would depend very much on the nature and the size of the farm and whether or not this property is appropriate for the use in the farm. Quite detailed stuff around agricultural property. Again, it's something we can chat about separately if you're interested in it. Okay, so another top tip is if you don't need it, consider giving it away now. So in terms of cash, there are annual exemptions. Everybody gets £3,000 a year that they can give away, and it is use it or lose it. You do get a 1-year carryback though. You've then got the small gifts exemption, £250 a person per year. Again, use it or lose it, so you can make small gifts. When this amount was set at 250, it was a very long time ago. 250 now, it probably is a very small gift in many people's eyes. It was a lot. It felt like a lot more when this was first set up. Gifts on marriage, again, you can do this if somebody's getting married, if it's one of your children, you can give them £5,000 without worrying about any inheritance tax kicking in. Remote ancestors, it's £2,500, and then anybody else, it's £1,000 if you're feeling generous. The other one to consider that people often forget is the gifts out of income. Now, if you are making a gift out of income, there is no restriction on the value you can give away. What you just have to be able to do is to show that it is out of accumulated, so it's accumulated income from the current year and the previous year, i.e. you're not having to dip into your capital or much older accumulated income, and you need to be able to establish a regular pattern to show that this is now part of your normal expenditure. When you do that, even if you were to pass away within 7 years, HMRC will not usually ask for any inheritance tax on this. The big one, of course, is a potentially exempt transfer. So if you want to make a gift that is much larger than those we've discussed, or isn't part of your normal income, normal expenditure rather, then there is this 7-year clock. So you're able to give away something, and if you survive 7 years, you will not pay, or your estate will not pay the inheritance tax on it. You need to be careful though, because if it is a non-cash gift that is being made, it can attract CGT, depending on what the nature of the asset is. So if business assets are being given away, there's holdover relief to consider, which may not trigger a gain, but there are pros and cons to claiming holdover relief. If it is less than 7 years when the person who made the gift passes away, then it will need to be considered when calculating how much inheritance tax is due by the estate. This is when life insurance becomes really important, really significant, and we have good contacts with people who can arrange this kind of thing for you. If anything does happen, and you survived at least 3 years from the date of the gift, then your family can consider claiming taper relief. Now, this only applies if tax becomes payable. So if the gifts that were made that are brought into charge are less than the nil rate band at that time, taper relief will not help you to reduce the tax. This only applies if tax becomes payable. If tax becomes payable, then effectively for every additional year after the first 3 that you survived, there is a reduction of 20% of how much tax is due on that. So the effective rates of tax for 3 to 4 years are 32%, and this goes all the way up to 6 to 7 years, where the estate is only really paying 8% on that. This is quite useful again in terms of insurance, because it means that when your beneficiaries take out insurance, they can do it on a reducing balance, which can reduce the cost sometimes. But it's always a gamble. If you make gifts during your lifetime, there is no guarantee of what the beneficiary of that gift is going to do with it. So, for example, they may decide not to keep the shares in the family business and shut it down. At that point, BPR is lost. And if you were to pass away within 7 years of that, the BPR will not apply on the estate, and they will end up paying the full amount of inheritance tax. The nil rate ban is offset against failed potentially exempt transfers first on a first in, first out basis. So it means that if you make later gifts, the individuals then are more likely to have to pay tax than the earlier you give to pay. So if you like one of your children more, I shouldn't say this, make sure they get the gifts first, because it will be the other one that ends up paying the tax later. Bit mean, but a lot of people need to plan around this and consider it though, because the problem is if you have benefited someone and then they do not participate in the will later, for example, they will have had the benefit of the nil rate ban, whereas the beneficiaries of the will not. And then you need to weigh up whether or not that's the impact you want to have. There are additional impacts of trusts that need to be considered. Again, I'm not going to go into detail, but if you have had a trust set up, it could cast what they call a 14-year shadow, and you could end up finding out, your beneficiaries can end up finding that gifts that were made, or trusts that were set up in the previous 14 years rather than the previous 7, could have an impact on how much tax is paid. If gifts are made and capital gains tax is triggered, the CGT cost could end up outweighing the IHT saved if taper relief doesn't apply. There is no relief for capital gains tax that is paid during a lifetime if that asset then comes back into charge later. In terms of other considerations, you need to consider whether or not this is a genuine gift. As Tim related to earlier, gifts with reservation benefit laws are drawn very widely. So if you make a gift and you continue to benefit from it. So the family home is the classic example. You carry on living there, for example, you don't meet certain conditions, i.e. you give away the whole thing and your children don't live with you or you don't pay rent for it. It doesn't matter that you gave it away. It will still be considered for inheritance tax purposes as fully taxable when you pass away. Tiny mention on trust again. There are lots of tax planning that can be done with this. Lifetime gifting into trust is quite useful, or you might want to consider for asset planning or asset protection, thinking about creating a will on death. It may be that your beneficiaries are too young or they're not capable of taking on large sums of money or assets. They're very useful for blended families, and they can also be quite helpful for protecting from divorce and bankruptcy. No one knows who their children are going to marry or their grandchildren are going to marry necessarily. And so these are quite useful to kind of provide a layer of protection that makes more people feel comfortable, certainly with lifetime gifting. They can also make probate easier. So there are certain sorts of trusts that are done during their lifetime, which while they aren't effective for tax planning purposes, they can be effective for making sure probate's a little easier and potentially for protecting from other income related benefits later. So what do we know about what is changing and what might change? Let's have a think about who that's going to affect. We know that grants on credit will be changing or has changed from April 2024. This broadly means that people who cannot afford to pay the inheritance tax up front and who don't qualify for paying the 10-year instalment, they will no longer have to prove to HMRC that they have sought professional third-party lending before they're able to get a grant on credit. HMRC will agree then, potentially agree to give you the grant on credit. When I say grant, I mean probate. You can't get probate unless you've paid the tax effectively or you've agreed to pay the tax. There was changes to APR and wooden relief, which we'll look about. There's a few changes on the interest rates. We also know that coming soon is the consultation on non-doms and the changes to protected trust status. So looking at APR first, this will be restricted to, well, it's now restricted to assets situated in the UK. However, they are now introducing relief from next year that will cover land that's been managed under environmental agreements. I've seen clients who have put environmental agreement plans in place, and this is good news for them because it now means that land is much more likely to qualify and it's not just seen as an investment. Interest rates are one to really consider. If you have got somebody who has agreed to pay the inheritance tax over 10 yearly instalments, which you can do for property, for example, or you might do for a business where BPR doesn't apply for, the interest rates are high now. They are now at 7.75%. That's an increase of 4% in the last, like just under a year. So they do track the base rate. So as the base rate goes up, the interest rate will go up as well. So this just you need to make people aware of this. If you're advising people that they might want to pay by installment, that they need to factor in the interest, and so this doesn't come in as a nasty charge. It might go down. We hope it will go down. The Americans reduced theirs yesterday, I think. We don't know. We'll see what happens. But at the moment, it's 7.75%. What future changes to look out for? Okay, well, non-doms is the big one. IHT, at the moment, the way it works, there is no IHT on non-UK situs assets for those who are not domiciled in the UK. They'll still pay tax on their UK situs assets, and that includes any indirectly held residential property. So you can't now hold a property under an offshore company and an offshore trust and avoid IHT. That just doesn't wash anymore. Offshore assets are excluded unless the person is deemed domiciled. So currently we have the 15 out of 20 year rule. So if somebody is UK tax resident for 15 out of the last 20 tax years, they will be deemed to be domiciled here. You also need to, though, consider domicile of choice, because some individuals are domiciled here because they've cut their ties with everywhere else. They're not domiciled anywhere else, they're here. And that may sometimes happen in less than 15 years. At the moment, we have the protective trust regime, which allows individuals to keep their overseas assets outside the UK tax net long term. Now, these apply to people who are able to set these trusts up prior to becoming deemed domicile, and are very useful. At the moment, we also have restrictions on interspousal gifts, which we've talked about a little bit already. What do we think is going to happen? Well, we've had the budget. They have not told us what is going to happen, although in the guidance that were provided, there are some suggestions of what might come out of the impending consultation. We think that they may move to a residency-based system, potentially. So rather than looking at whether you're domiciled here, they will look at how long you've been resident in the UK. Now, we expect it to be a lot shorter period as well. one of the years that has been mooted as a 10-year grace period. So somebody coming to the UK will have 10 years before they become UK resident, UK domiciled or UK liable to IHT. Again, we don't know. It may be a lot shorter than that. We also understand from what's been suggested that it may be the case where long-term residents who then leave the UK will have a 10-year tail. Now, the tail at the moment is a lot less than that. If you leave the UK and you lose your deemed domicile status, you can do that within 6 years at the moment. 10 years is going to extend that. What we don't know and what could be useful to our UK domicile clients or those born in the UK is whether this will be extended to people who were born here who then yet leave. So I've been here all my life, but if I leave and I'm away for 10 years, does that mean I'm outside of the net for my non-UK assets? We don't know yet. That could be an interesting planning opportunity. When it comes to offshore and protected trust, we know again that there will be changes, and we suspect that they may fit more into the mooted 4-year period that is being talked about for income tax and capital gains tax. Now, we don't know whether existing trusts will be protected or whether they'll maintain their protected status. We know that new ones probably won't, and that could mean you end up having a 2-tier system for IHT when it comes to overseas trusts. That's going to get complicated quickly, so we'll see what happens. Interestingly, though, this week we have had announcements from the Labour Party as to what they're going to consider doing as well. So it may be that all of the Conservative plans won't ever come to pass. The wording was that they plan to close the loopholes for non-doms and that they will scrap protected trusts. Now, we don't know whether that's going to affect existing protected trusts. We don't know how quickly they can introduce that, although if we have an election this year, it could be before April 2025, which is when we're expecting the current changes to happen. What we need to consider is how quickly can we act? How many of our clients, for those of us who are advisors, are going to be affected by this if the Labour Party do this? We are already in chat, in discussions with overseas trustees, and it may be worth having a chat with us as to whether or not there is anything that can be done now, because we do not necessarily have the time that we thought we would have to do this. Anyway, I'm going to let Tim talk about that, but if you need to contact me, that is me. You can contact me. We'll share the slides. If we can reduce the size of the slides, they're a bit large at the moment, and Hilary says she can do it, so we're all good. But yeah, so if you have any questions, please do get in contact. I'm going to hand back to Tim.
Thank you very much, Michaela. Can I just say that was excellent? I'm going to say that now. And I listened to every single word you said. So fantastic. Thank you very much. Can I just say one couple final things on what Michaela said, if I may? I know we've got a mixture of accountants watching this today and clients. And I'm sure, approximately 300, I'm guessing, something like that. I think you actually tuned in. I'm sure a lot of you, whether you're a client or an accountant in practice, will have issues. And what you should do is reach out to Michaela, email her, tell her the problems you've got, what you want to get achieved, what you want to come out with, and she'll sort it out for you. So please, following this webinar, contact Michaela and reach out to her with your problems, with your issues, any planning you need for IHT, and we'd be delighted to help you. Okay, now just to finish things, if we can
sorry, we've had a couple of questions on the chat. I'm going to have a look at those. If I can help with them, I will. If not, I'll ask people to drop me an email so I can deal with those separately. Is that okay? Sorry, let you carry on. Sorry.
No problems, no problems. Right, okay, moving on from that, can I just remind you, if you go to our website, you can see all the forthcoming webinars that we've got going on. I don't know if we've got a slide that we can just put up to show the webinars. I can't quite see it at the moment. Maybe it's me, but don't worry. If you go to our website, you can see all the webinars that we've got coming up in the near future. Can I just highlight 2 that I'm involved with, actually? Yeah, there we go. Right, I'm going to highlight 2 in particular. You want to come to all of them, but 2 that I'm involved with. On Monday, the 20th of May, I'm going to be talking about the taxation of entertainers, artists, and social media influencers. Let me give you a little sweetener for that course on the entertainers one on Monday, the 20th of May. And I'm going to give you a question to think about before then. If you have a client that's a well-known actress and she goes to the BAFTA Awards and she buys a beautiful dress costing a fortune. I never allow my wife to buy such a dress like that, but she does. And she has all her hair made up for the event. Do you get relief for that? That's one of the things that I'll be answering when we have that talk on Monday the 20th. I think it's a really important presentation. I think social media influencers, from the research that I've done and my involvement with them, a lot of them are trading without them realizing it for tax purposes. So we'll cover so much in that area as well. So that's one. I mean, all of these are really worth having a look at. And the other one that I'm going to be doing on Wednesday, the 26th of June, is company tax computations. This is a really topical subject because companies incur so much expenditure. Will this expenditure be allowable or won't it? Again, I'll give you another sweetener for that one. If you've got a company and they hire a box at the O2 Arena, do they get corporation tax relief for that? All of it? Part of it? These are the sorts of things we'll be looking at these various webinars. So we're going to finish now. Keep up with us. Keep regularly looking at our website to see the events because we add to them regularly. See our blogs. I'm going to thank Michaela one last time for a really excellent presentation this morning.
My pleasure.
That I found, you know, I was just glued to. So thank you ever so much. And we're going to finish now. Enjoy the rest of your day. Keep in touch with us. Bye-bye.
And I'll come back on any questions. So I've got your details on it. I will come back as many questions as I can. If you didn't leave us your details, please drop me or Tim an email with your name and contact details, and we will contact you. Not a problem at all.
Thank
you.
you.
Take care.
Enjoy the rest of your day. Bye-bye.